The Italian tax authorities have a reputation for adopting aggressive position in tax audits. So maybe let's start with Italy. I hand over to Marina that will address the subject from the Italian perspective. Marina.
Thank you, Anne-Laure, and good afternoon, everybody. Before dispelling the myth that the Italian tax authority is one of the most aggressive in Europe, let me introduce myself. My name is Marina Lombardo, and I'm the Italian transfer pricing team leader in WTS R&A. I'm working with WTS for more than 14 years. I've taught international tax law at a university for 20 years, and I'm specialized in transfer pricing and international tax dispute settlement with a special focus on financial sector. So, to answer Anne-Laure's question about the dangerous approach of the Italian tax authority during a tax audit, let me say that in the last 10 years, we saw an improvement of the competence of public officers and a more cooperative approach during the tax audit when the taxpayer has acted in good faith, especially in case of transfer pricing assessment. We focus on discuss on middle-sized enterprises, which represent the majority of the Italian economic fabric. So let us start by taking up the definition adopted by the Italian tax authority in the transfer pricing rules. As you can see in this first slide, the term small and medium-sized enterprises refers to company with turnover or revenues that do not exceed 15 million euro for the tax period in which the transfer pricing documentation refers. So they are identified by the amount of revenues in each fiscal year, 15 million euro. However, please note this exception because this definition does not include entities who directly or indirectly control or are controlled by an entity that cannot be qualified as a small and medium-sized enterprise. What does it mean? It means, for example, that a small Italian subsidiary of a company with revenues above 15 million is no longer included in the group of small and medium-sized enterprise for transfer pricing purpose. So you can imagine the impact of this exemption on the restriction of the number of medium-small company for transfer pricing purpose. Please note that this is the definition to be applied when drafting the Italian transfer pricing documentation, and it is different from definition provided in other regulatory contexts, for example, in the civil law, in the European regulation. However, today we focus only on this definition. This definition has been changed in fiscal year 2020, excluding from the small medium-sized enterprises the entity that are controlled directly or indirectly by a non-small medium-sized. This means that if the Italian entity or its parent or control company is not a small medium entity, the facilitation does not apply. But which facilitation? Under the Italian transfer pricing rule, these entities, as you can read in the slide, are entitled not to update intercompany transactions data of the local file with reference of the two tax periods subsequent to the one to which the documentation refers. This condition, the condition for applying this facilitation are two. The first one, the comparability analysis is based on information obtained from publicity available sources, for example, Orbis or AIDA. And the second, the elements of the comparability analysis have not been subject to significant changes in the said two tax periods. What does it mean? This means that the economic analysis performed, for example, for fiscal year 2022 can be used in the transfer pricing documentation for fiscal year 22, 23, and 24, provided that the elements and the assumption on which the analysis is based have not been changed significantly in 23 and 24. I just told you that the definition changed in 2020. However, this facilitation is the same as the one applicable from the first introduction of the Italian transfer pricing documentation rule in 2010. And we can go to the next slide, please. So let me give you a quick overview of the main changes to the Italian transfer pricing documentation rules applicable from fiscal year 2020, which are not directly addressed to the middle-sized enterprise, but these regulations, in essence, impact more on medium-sized companies. So let's see why. In the left column, I summarize the main principles still applicable to the transfer pricing documentation of small, medium enterprises. First of all, please remember that the transfer pricing documentation is not an Italian mandatory fulfillment. It's just an option for the Italian taxpayer that grants the penalty protection for both administrative and criminal penalties. Furthermore, there is a simplified approach for small, medium entities relating to the transfer pricing documentation content, that is the facilitation just seen. Additionally, the local file must be in Italian language. The master file and the attachment, such as intercompany agreements or the benchmarking analysis, could be in English and translated into Italian just upon the tax administration request. And for the TP documentation to be valid for penalty protection, it must be reported in the annual tax return, which implies that a final deadline for finalization of the work is provided for. In the right column, there are the main changes introduced in 2020 to document the group transfer pricing policy for penalty protection purposes, and which directly or indirectly, see stressed in blue color, have a particular effect on medium-sized enterprises. So the content is significantly changed from 2020. Please note that unlike other countries' approach, the Italian rules require that the documentation be drafting accordingly to a rigid and unchangeable structure of heading, paragraph, subsection, of course, with reasonable exemption indeed. From 2020, the master file is an essential part of the Italian transfer pricing documentation of all Italian taxpayers. Until 2020, maybe as you know, Italian subsidiaries, which under the old rules, they are almost always fell under the definition of medium-sized companies, were only required to prepare the local file. Now they must prepare also the master file. Another important feature that simplifies the drafting of the local file and makes it consistent with the OEC guidelines is the possibility of including in the local file only those transactions on which penalty protection is desired, and thus only those with material amounts or those relating to more complex transactions concerning TP policies, such as the interest flows or royalties. On the contrary, until 2020, the arm's length principle had to be analyzed in all the intercompany transactions involving the Italian entity. Otherwise, the local file could be considered inadequate for penalty protection purpose. The other point has already been discussed, the new definition of small, medium-sized enterprise. With the new definition, it is rare the facilitation simplifying the local file is actually applicable to Italian subsidiary of multinational groups, unfortunately. The other important innovation concerns the application of the safe harbor rules for the economic analysis of prices applied to low value added intragroup services, the cost plus 5 method, consistently with the OECD transfer pricing guidelines, the Chapter 7, and also the Italian Decree May 2018, Article 7. So this safe harbor rules is applicable only if specific information is provided in the local file, well detailed in the Italian rules. And this information should describe the cost basis, the allocation keys, and the reason for the choices made consistently with the arm's length principle. Last but not least, the Italian transfer pricing documentation, master file and local file, I repeat, both of them, must be signed and time-stamped. Beyond the appearance, this is a new rule with a major impact on drafting the documentation, because it obliges the taxpayer to finalize the work by a certain date that is printed electronically on the documents and correspond to the deadline for sending the annual tax return electronically. Please note that since fiscal year 2023, the deadline has been reduced by 2 months. So the new deadline has been brought forward to September the 13th, 2024 for companies with financial year ending the December 31st, and no more November the 30th. Good, but why is the topic of transfer pricing so important and essential when assessing the tax risk of even a medium-sized company? Next slide, please. Okay, we can list several answers, even with an ethical or sustainable flavor, but the first answer I feel compelled to give you is that this is an essential issue, because it is the first that is normally subjected to tax inspection by the Italian tax authority. And why this happened? Because since the transfer pricing is not an exact science, everything can be questioned, and in the search of a middle ground, it is easy for the tax authority to retrieve taxable matter. So, and this is especially true in case of intragroup services and management fees. But I remember you that this specific topic will be covered in our next transfer pricing webinar in May by my colleague Giovanni Rolle. In the first column, you can see the drivers on the basis of which the Italian tax authority now is selecting taxpayers to be audited in recent months. So they are mainly the following: the business sector, special interests, enterprise with a turnover exceeding 5.16 millions, cross-border intercompany transactions, and R&D costs. So as mentioned before, the possession of the transfer pricing documentation must be disclosed in the annual tax return and shows the existence of cross-border intercompany transaction in the fiscal year. So a tax audit could start. The Italian tax authorities are entitled to make an assessment in relation to corporate taxes returns upon the end of the 5th calendar year following the year in which the tax return was filed. So right now, the fiscal year under investigation are fiscal year 2018, 19, and 20. The inspection usually begins with the sending of a written questionnaire in which they ask, among other things, to submit the transfer pricing documentation within 20 days. In this regard, I would like to point out that if you have not prepared the transfer pricing documentation, and I repeat that in Italy this is not an obligation, the Italian tax authority sends you a questionnaire with a list of questions practically identical to the structure of the TP local file, which you have the duty to prepare within 20 days. That is a very tight time frame. I point out you because if you decide not to draw up the transfer pricing file for reason of cost or appropriateness, in the event of a tax audit, you will indirectly be obliged to draft a sort of transfer pricing documentation in just 20 days, and on past fiscal year for which it may be complicated to retrace information and supporting documentation. So my advice, strong advice, is not to wait for the tax authority request, but to draw up the transfer pricing documentation every fiscal year with recent information and optimal time framing. The tax audit can take place at the taxpayer premises as well as in the tax authority's office, and the tax auditor can stay at the taxpayer premises for no longer than 60 days, 30 ordinary and 30 the extension. But how can we avoid a transfer pricing audit or resolve it without a tax court ruling? In the second column, I list the main instruments made available by the Italian legislator for this purpose. We'd apologize if I cannot go into their complex feature in depth given the little time I left to me. So the first is the Advanced Tax Agreement for Enterprises with International Activities. They are binding agreement between taxpayer and the Italian tax authority, which may be requested by resident companies conducting international activities, having transactions with non-resident associated enterprises. The agreement remains in force for 5 years. In case of bilateral or multilateral APAs, the validity can start from the date of the application filing, consistently with a mutual agreement procedure under Article 25 of the Model Tax Convention. Another tool provided by the Italian legislator to prevent tax litigation on TP issue is the so-called unilateral corresponding downward adjustment. The purpose is to eliminate double taxation when a foreign tax authority makes a primary adjustment under the mutual agreement procedure. However, when a tax audit starts, the assessment procedure may lead to a tax assessment notice. We can appeal to the tax authority or reach an agreement. This agreement is called accertamento con adesione if the agreement is reached before the tax litigation starts, or conciliazione giudiziale if the agreement interrupts and ends the tax litigation. In the third column, I've listed for completeness the main means available to Italian taxpayer to prevent and resolve international tax disputes on TP issues. But since I have run out of time, and since they are international tax rules that not purely domestic, I will not proceed with an in-depth examination. Next slide, please. This is the last one. However, I would like to conclude my presentation by pointing out that the issue of transfer pricing cannot and must not be limited to the drafting of the local file and master file, but requires an integrated approach at various levels and in the various decision-making phases of the company, which include the strategic planning and the monitoring of business risks with consequences on corporate sustainability, and correct collaborative approach with the tax authority during the audit or to avoid tax litigation. It's now time to thank you for your attention and ask my esteemed colleague Eric if there are any specific transfer pricing standards or approaches in France aimed at medium-sized company. Eric, I leave you the floor. Thank you very much.